Well, good day, traders, and we're closing out the week. And what a week it's been. It's been a fascinating week to understand the global macro scenario that's playing through. You know, we've been debating what's happening in the Brexit negotiations. We do look like we're getting some sort of alignment. It looks like we're getting closer to a point where Theresa May will be able to sell a deal to her parliamentary MPs. That looks like it will probably be voted down. The likely date is at the moment that market anticipating is between the 10th of December and the 18th of December. You know, if you look at implied volatility on a 1 month basis or a 3 month basis, or certainly in a 1 week basis as well, you can see implied volatility in cable and sterling crosses is still very elevated. To give you an understanding about the potential moves that the markets are implying through those vols, 1 month cable is seeing about a 420 point move, and of course volatility is agnostic, so it could be up, it could be down, but the market is pricing a 420 point move in cable over the next month, and that sort of falls over the expected deadline as well. And you know, you could be seeing cable up at 132, you could see it down at 126. You know, that's been the range that's been in place for a number of months now. Whether that range gets taken out, I think, you know, is going to be very important. But you know, I think that we get a situation where it's voted down, and I still see the camp that sit in that camp as well. Then you could see some big volatility before we see that being reworked. We've also seen Italy coming back into the forefront as well. We saw an absolutely terrible bond auction from the Italian government last couple of days. They've offered this to both institutional and to retail investors as well. And I think the important part is that institutional, this is the second lowest demand from these guys since I think 2012, just before Mario Draghi came out with his whatever it takes. You've also seen the lowest demand from retail investors that you've ever seen in an Italian bond auction that goes out to the public. And again, that's a bit of a worry considering as the ECB will stop its ECB bond buying program in December, and then who is going to be buying Italian debt. We are quite concerned about the spread that we've got in Italian debt over German bonds, because if Italian public and if the Italian banks are asked to buy more, and if they don't, then of course that spread's going to widen, and the Italian banks hold a lot of Italian debt on their balance sheet, so the perception of the balance sheets obviously will deteriorate in that situation, and euro stocks will be under further pressure than where we are. So we are continuing to watch that spread in Italy's BTP over German bonds going forward. If you look at the US, I think this is to me the more interesting picture and the more longer lasting picture. Existing home sales this week, the lowest levels on a year-on-year basis since 2014. You've got core capex orders down 2.9% year on year. You've got leading indicators, which look at the top 10 forward leading indicators, growing at a 5.9% clip. But that's come off quite sharply in terms of that growth rate. And that's something that we have seen being a really good precursor of recessions there. We've seen durable good orders down 4.4%. So it's pretty clear that capex is being cut back. And whether that's a reflection of the fall in oil price is yet to be seen. The November numbers will therefore be really closely watched. But we're seeing capital intentions being pushed back. And that's something that the Fed talked about at their last statement, where they said business investment is moderated. We've seen housing numbers coming under pressure for some time. We've seen lumber prices having a bit of a rebound this week, but certainly being decimated with the reflection of what's happening in the US housing market. Autos have been hit pretty hard. So those are the three areas that we are a little bit concerned with. We've last week, through this week and last week, seen Fed officials such as Jerome Powell becoming more nuanced. Richard Clarida, the vice chair, showing his concern about what's happening in these parts of the economy. But on the positive side, the US is still growing at 3.5%, and we're going to get another revision this coming week where we're expecting that to be revised up from 3.5% to 3.6%. Employment is still very, very strong. In fact, on next year's projections from the Fed, you're expecting that to go down to 3.5%, which is a full 100 basis points below what they consider to be full employment, which, of course, if you believe in the Phillips curve, should be inflationary going forward. This coming week, we're going to be looking at core PCE, which, of course, is the preferred inflation measure that the Fed look at. And that's expected to stay fairly at target at 1.9%. But if you get downside numbers, that's going to be a concern. But at the same time, we're going to be concerned what's happening in the oil price, because the inflation expectations are falling. That's obviously going to be pleasing Donald Trump to an extent, because you have seen the interest rate markets really pricing out interest rate hikes going forward. And therefore, as we go into the new week, what am I looking at? What is going to be the central focus? Because of these dynamics that I'm speaking about, again, as we go into Wednesday, we're going to hear from Richard Clarida, the vice chair. Will he change his tune? Will he give us any more colour from what he gave us previously, where he talked about the neutral rate and how far away we are at the moment? We're going to hear from other Fed members such as Mr. Bostic. We're going to hear from Charles Evans and also Esther George, and their views on rates will be looked at and disseminated very closely as well. And then Thursday at 4 o'clock in the morning, we'll hear from it again from Jerome Powell, where he talks about the economy, and his words will be very, very interesting for financial market traders. If you look at interest rate markets, as I say, we've pared back expectations very aggressively here. If you look at what the Fed are calling for 2019, they expect to see 3 rate hikes and 1 rate hike in 2020. The euro-dollar market now is pricing in about 34 basis points for next year, which gives us 1 hike and about a 38% chance of a second, so we're well below that. And in fact, if you look at in 2020, the market's got a very small chance of a rate cut relative to the Fed with 1. So the market is saying, we're pretty close to the end of the rate hike cycle, and that's why I'm looking very, very closely next week at what happens with the Fed. What would they be saying? Especially given that the market news publication came out of an article during this week suggesting that we could see a pause after December. Now, what does that mean? That means emerging markets once again could look like a good bet as we come through the new week. We're already starting to see some good buying in the rupiah, the rupee. Some of the emerging market currencies could come alive if we do see a more dovish tone from the Fed once again.